program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.
Hello and welcome to the Global View on this Monday. I'm Andrew Gagan. Good to have you with us again here at AusBiz. So let's get across how we finished last week. Stocks in Europe turned negative, but risk sentiment improved later in the day when President Trump gave assurances that his proposed 100% tariff on Chinese imports would not be sustainable. That saw stocks on Wall Street end higher, while quarterly results from regional banks eased concerns about credit risks. For the week, the S&P gained 1.7%, the NASDAQ rose more than 2%, and the Dow climbed more than 1.5%. On Friday, the S&P Regional Banks Index climbed close to 2% after tumbling 6% the previous session, with Truist Financial gaining after the bank reported higher third quarter profit. And Zion shares rebounded from losses the day before to close 6% higher. American Express raised the lower end of its 2025 profit and revenue forecasts as its customers look past economic uncertainty and continued spending ahead of the holiday season. State Street dropped after the bank's third quarter net interest income missed estimates. Elsewhere, shares of Oracle fell after projecting its cloud infrastructure revenue would surge to $166 billion by fiscal 2030. Chipmaker Micron Technology's plans to stop supplying server chips to data centers to China. That was a report according to Reuters, after the business failed to recover from a 2023 government ban on its products. Eli Lilly shares fell after President Trump said he would bring down prices of weight loss drugs. And among the companies reporting quarterly results this week are Tesla and Netflix. Well, President Trump has softened his threat of imposing 100% tariffs on Chinese exports, saying it's not sustainable, but that's what the number is, adding that the outcome of the trade dispute will be fine and that he will meet with Chinese President Xi in South Korea in a couple of weeks' time. Treasury Secretary Scott Bessent saying, I think that things have de-escalated. We hope that China will show the respect that we've shown them. And I'm confident that President Trump, because of his relationship with President Xi, will be able to get things back on a good course. While the head of the World Trade Organization has urged the US and China to de-escalate trade tensions, warning that a decoupling by the world's two largest economies could cut global economic output by 7% over the longer term. Well, the two-year Treasury yield rose to 3.47%, the 10-year pushing back above 4%. Markets pricing in a 95% chance the Fed funds rate will be cut by 25 basis points at the next meeting at the end of the month. US dollar index was down around 0.5% on Friday. The Aussie is currently at 65.1 US cents. Oil prices managed small gains on Friday, but were headed for a weekly loss of nearly 3%. After the International Energy Agency forecasting growing glut, and US President Trump and Russian President Putin agreed to meet to discuss Ukraine shortly. Brent crude futures settling up at $61 a barrel. Copper fell around 0.5%, while iron ore was down 1.3% to 103 US a tonne. And the gold price pulled back after hitting a record above 4,300 an ounce. Spot gold down more than 1.5%. And Bitcoin, it is trading just above 109,000 US dollars. Well, let's get across what we're seeing more globally at the moment with a focus on New Zealand. Greg Smith joining us from Generator Investment Management. Greg, welcome back. Good to see you.
Thanks, Andrew. Good to see you too.
Let's ask first how you've opened there.
We have opened slightly softer, so the NZX 50 is down 0.13%. A bit of mixed moves in some of the large caps here. We've got Meridian, they're lower, but we've got Mercury, they're up, so they're both gentailers, and Contact's up as well. We have had one interesting announcement this morning from Infratil. They had a good week last week, actually, and they own CDC, which is the largest data centers owner operator in Australasia, and they announced a deal with Nvidia, which obviously got investors going. It's a 40 megawatt data center. And as we know, Andrew, data centers, they use lots of electricity, don't they? And just on a similar sort of token, Infratil's announced that it's buying up to 5% more of Contact Energy, which is one of our largest electricity companies over here. So they're buying that off TECT. So Infratil shares slightly softer, but did have a good week last week.
Now, Greg, I gather you've just had the latest inflation data out. Have you got across that?
Yeah, I have. So this is the CPI for the September quarter. So it was 2.7% in the June quarter. It has come in at 3%. So that's in line with expectations. And I suppose the most interesting thing about that is we talked recently about how the RBNZ cut rates by a jumbo 0.5%. See, price stability is a key mandate for them, and so 1 to 3% is their target, so at the top end of that range. But yeah, I don't think the market will be too phased about that. We're still looking potentially another quarter point cut next month. Is at the top of the range. If you look at what's sort of driving it, it was council rates, so that's sort of a bit uncontrollable in terms of the OCR, and also food prices. But food prices in September actually fell for the first time since February, so that should be less of a tailwind for inflation going forward. And rent growth, that's slowed to its lowest since 2011. So the RBNZ expects inflation to fall back towards 2% next year. The currency won't be helpful. Our currency has been weakening, so that's going to drive up imported stuff. But it looks generally like with the heat coming out of, well, not even coming out of our economy is still in a pretty soft place, and that's what the RBNZ is trying to amend. So I think that comes in 3%. That's in line with what expected. It's up 1% on the previous quarter. So we still get the RBNZ rate cut next month, we think.
Yeah, where do you see the RBNZ cash rate landing eventually, Greg?
I think we're going to go below, certainly below sort of around the sort of 2% region, I think, if not below it. The mandate, primary mandate is price stability, but they do have indicated a more and more of a leaning towards where the economy is at. Our economy is basically not growing. In fact, it contracted in the last quarter by 0.9%. That was triple what they expected. Things are very, very soft over here. So I think they'll want to, as they normally do, try and sort of get more and more ahead of that. That's why we have that half percent rate cut on the OCR. I think we get another 2% rate cut, sorry, 0.25% rate cut next month when they meet in November. And we have got a changing of the guards we've sort of talked about before with the new governor, but probably most of the heavy sort of downward movement in the OCR will be done by then. So the cash rate currently is 2.5%. We go down to 2.25%, but we could still well be down below that 2% region next year. There's some forecasts, Andrew, that are saying we could get down to 1.75. Not quite sure about that. You'd be hoping we get some green shoots coming through over sort of the December-January period data-wise, which is when the RBNZ is effectively on leave, if you like. And then presume we get some of that, which I think we will. We've got around about 50% or 45%, should I say, of mortgage holders coming off their existing rates onto lower rates in the next sort of 4 to 5 months. And talking to businesses anecdotally, they're feeling a little bit more upbeat about the outlook. But things are still pretty tough, but potentially below 2% on the OCR.
Greg, let's move to what we're seeing on Wall Street. Of course, we're now earnings season well and truly underway. We've had the banks. We're getting some larger companies reporting this week, including Tesla and Netflix, but also investors very much focused on the US-China trade spat. Hopes there, perhaps, of a de-escalation there, given some more conciliatory language from the president.
Yeah, absolutely. And it was interesting, obviously, how we got that reaction, didn't we, sort of after the market going back a week, had a pretty big fall on the Friday, and there was some conciliatory comments over the weekend. So they do seem to be paying attention to that. But look, it is a big deal. We've obviously had trade tensions escalate earlier in the year and sort of subside and ebb and flow. But yeah, we're looking for that deal with China. And they both seem to be sort of shots across the bow in terms of who's got the upper hand and comments around rare earths and tariffs. But yeah, the latest, I suppose, salvo is that Trump's saying that 100% tariff against China is not sustainable. So you sort of feel like things are going to soften. That they're due to meet. It seems like that meeting is still going to be on. It's going to be fascinating. Hopefully we do get some sort of understanding before the end of the year. And it feels like the White House sort of leaning that way, but we'll want to have be able to show that they haven't completely rolled over while securing some sort of deal, and I'm sure it'll be lauded as a tremendous deal as and when it does come. But we have seen this before in the lead up to deals with Europe and South Korea and the like. There's been lots of sort of pressure exerted by the White House, but this time around, there's, I suppose, China obviously has quite a bit of muscle itself. So it'll be fascinating how that goes in the next few weeks. The markets generally appear to be discounting that. As you said, the earnings season's gone really well, so I think that's helping sentiment. We did that have that little bit of wobble over those regional banks, but you had the big banks, JP Morgan Chase, Goldman Sachs, Wells Fargo. That all painted a pretty positive picture of the economy. And indeed, American Express did on Friday as well, basically saying US account holders are paying their bills. Again, they raised their forecast. So if we continue to get that, that's going to add more sort of fuel to the fire. Obviously, technology is still going pretty well as well. You had like Alphabet, that was up 7%. I do think it's interesting, your comments more and more we're hearing about, is this bubble in terms of AI? I think, there's some good reasons to think it's not, and some of those comparisons with the dot-com bubble in the late 90s are a bit unfair. Obviously there was the PE became sort of known as price to eyeballs back then, didn't it? But companies in the sector are generating earnings and revenue. Look at Nvidia. It may well be on sort of 30 odd times earnings, but it's growing revenues and earnings at 50% over the next couple of years. You've got $1 trillion plus going into all the various infrastructure. You've got 45% of US companies using AI. And I guess the other big difference as well, the companies that we're talking about are cash rich. You look at Alphabet, they got 100 billion almost in cash. So I think there's a reason to think that, there's some frothiness for sure, but it's to compare it to, say, the AI, what's happening in AI to the dot-com bubble, maybe a little bit unfair.
Greg, enjoy your week. Thanks for joining us from Generate.
Thanks, Andrew. Bye for now.
All right, let's check where we're likely to open in just a minute or two when we get underway on this Monday. And SPI futures off marginally, they're just 7 points. So we'll get right across that in just a moment. Stay with us.
This program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.